Alrighty. Well, hello everyone, and thank you for your attendance at the Talaria quarterly webinar. I'm Al Reid, and before I hand over to Lance and Hugh, just a few housekeeping items. We have muted mics and block camera just to limit background noise and distraction, but you can use the Q&A function at any time to ask a question. We'll come to them at the end of the session, and I'll ask them on your behalf once the presentation is complete. So I'll hand over to Hugh and Lance to pick it up from here. So over to you guys.
Great. Thank you, Al. Thank you, everyone, for joining us at today's session. Just a little bit about Talaria for those of you who aren't too familiar with our firm. So we're a specialist global equity boutique managing or built around a specialist investment strategy that delivers some very distinct investment outcomes. The investment team now has over 140 years of combined experience and is privileged to manage over $2.5 billion on behalf of a diverse set of investors. So, Hugh, thank you for joining me today. Maybe a bit cheeky, actually, to start the session by quoting you, but something that you often talk about that's worth raising is that, you know, as investors, we're playing, as a manager, you're constantly making investment decisions under uncertainty. Yeah. And part of that process is ultimately playing a very serious game of odds and probabilities. Now, if I take us back, if we were sitting here in February 2024, it's fair to say that the narrower set of probabilities ultimately played out. Another way to put that is the narrower path of higher risk for reward ultimately played out through the year. But if I think about that in the context of starting 2025, you now have a case where investors are paying more for shares, ultimately paying more for a unit of earnings from the shares they own, which in turn is driving valuations even higher. So perhaps an opportune time to think about prudence and table that approach for discussion. A nice place to start perhaps is to think about the current market cycle. You mentioned actually recently in your quarterly, and some of those attending today's webinar may have seen your note produced by the investment team, which does focus quite heavily on valuations, and in particular the US. Perhaps you can start by taking us through some insights on that.
Well, thanks, Lance, and welcome everybody. Thanks very much for your time. Obviously, I appreciate that. I think it'll be no great surprise to all of you listening that the strong gains that we saw, particularly in the US market last year, has left that market at a higher valuation multiple than traditionally we've seen. And what you're looking at here on the left-hand side of your screen is the forward PE, so just the next 12 months, 2025, for the S&P 500, which is about 23 times, and that compares to Japan and Europe, which are about 14 times forecast earnings, and the emerging market complex, which is on around about 12 times. And we've just aggregated that together really into the world equity market, ex the US, in that darker blue line. Now, to put that in context, we've just shown that in a Z-score. So that's really about what's the change around the average in terms of that relative valuations differential between the US equity market and the other opportunity set encapsulated by equities outside the US. What you're looking at there is it's about 2.5 standard deviations compared to the last 25 years. So in much more simple terms, what that means is that the US equity market, compared to the other opportunity set of equities around the world, has only been more expensive about 1% of the time in the last 25 years. Now, one of the things that I think is rightly pointed out and is definitely true is, of course, different equity indices have different makeups in terms of their sector characteristics and biases. Obviously, that's true in Australia with, banks and resources, for example, but it's equally true in the US, where there's a whole range of companies that are disproportionately largely represented in the US equity market, and predominantly that's in the broader tech sector. Okay, they've got a whole range of global leaders in tremendously profitable industries in that broad tech space. So I think it's an important and worthwhile distinction to say that, hey, what happens if we look apples for apples? Like, I want to kind of compare like with like. And that's what we've done on the right-hand side. So we've adjusted for those differences within the sector makeup of different regional indices. And lo and behold, of course, like most of the things in life with that are mathematical, you get the same answer. Okay, so yes, the sector adjusted PE in the US would fall to about 20 times, but from a Z score perspective, so that change from what you should averagely expect was only around one standard deviation as late as 2023. Now, one standard deviation just means about a third of the time it's more expensive. Okay, so 2 to 1 if you sort of think of odds and probabilities. Because of the strength in the US market, and I know we're going to talk a little bit about that in 2024, that's gone out to 2 standard deviations. So only 5% of the time going back over the last 30 years has the US equity market on that sector neutral PE basis, forward PE basis, been more expensive. And that's where we start 2025 as of today.
So Hugh, I mean, visually striking, to be at sort of 2 times. Is it fair to ask the question then? What's driven this? Like, is it an increase in earnings that fundamentally has created this change?
Yeah. Well, there's a bit of nuance around that. Let me start with that nuance and then unpack what you've got on the screen there, Lance.
Sure.
The reality is that a relatively small cohort of market-leading stocks, particularly in the S&P, not only drove returns, but actually they also had very strong earnings. So there was an alignment between the fundamental near-term performance, putting aside valuation, with the stock performance of a relatively narrow cohort of stocks. The more general picture is that actually, taking every stock equity as a like for like, so not capitalization weighting or so on, actually that the average kind of earnings outturn was only about 7% in aggregate. And if I go back now to that 2024, start of 2024 that you were referencing, we were talking then about the lagged impact of monetary policy, rising interest rates, feeding through into the real economy and ultimately into corporate profitability. That's what we're interested in, and that's obviously what we own in terms of the companies that we own.
And that's not different from other cycles, right? So there's usually a lag that is perhaps underestimated in your experience and some of the work that you've done.
Yeah, absolutely. So I think that shows this here. So what we're showing is the previous 6 tightening cycles back to 1982. When the end of that tightening cycle occurred, as represented by the peak in 2-year interest rates, and then the subsequent full 2-year profit outturn compared to the expectation at the moment that those 2-year yields peaked. And that's represented by the dark blue line, where you can see that the outturn, so there's always optimism when interest rates peak. We're going to go into an easing cycle, but the outturn on average is that the earnings were 24% lower in that full 2-year forward than had been expected at the moment when 2-year yields peak. So to answer your question, hey, what was 2024 driven by? What was the earnings outturn? That's really what those 3 lines that are not the dark blue are showing you. So the teal line is the S&P 500. So that's the capitalization weighted outturn in terms of current expectations for 2025 earnings as compared to October of 23, which is when 2-year yields peaked. And it's the same. Look under the surface, so you look at that S&P 500 equal weighted, so taking out the capitalization weighting and really those very large mega cap global platform companies that I referenced. And actually the outturn is about currently they're expecting to be 3% lower. And that is completely commensurate with the previous tightening and easing cycles back to 1982. And the third key thing is then you look at the S&P 500 equal weighted. So you take a much broader cohort and, you take away the size bias, and you can see that the earnings are expected as of today for 2025 compared to the expectations in October 23 for those 1,500 companies are actually 11% lower. Now, there's a couple of interesting and fairly different things from previous cycles, which partly explains this. One of the stark and notable changes to the structure of the economy that we're seeing show up in the corporate sector is that rising interest rates have disproportionately benefited the largest companies. So the very largest companies in a rising interest rate environment are seeing a falling interest charge through the profit and loss account. Why? Because they've got huge cash balances that suddenly they're earning not zero on, they're earning, 325, 425. So you think of the $100 billion of cash that Apple has on its balance sheet, rising interest rates have been actually a tailwind to their earnings. But then you think about the regular kind of company, the S&P 500, interest rates that they're being charged have gone from 2% to 7%. Clearly, that's a drag on their bottom line profitability. So we are seeing a bifurcation in terms of to the very, very largest companies in certain sectors. And, that speaks to concentration and monopoly power and so on, and business structure compared to the wider economy. So in answer to your question, the bottom line is that 2024's strong market returns were not a function of an improving earnings expectation for 2025.
And with history as our guide, the 1,500 equal weighted, perhaps slightly worse than in history. I'm a little low just because the data doesn't go back as far on the S&P equal weighted. But I can say that it was one of the fastest and largest relative tightening cycles that we've seen in the last 20 years. So that would disproportionately be a drag. I think also that's fairly bifurcated in terms of we've seen the high-end consumer, low-end consumer have very different experiences of the rising interest rate environment. And that's true all around the world. The ultra wealthy have been doing very well, rising asset prices, returns of higher returns on their cash balances and so on. And of course, the disproportionately 50% of the population that really doesn't own particularly much assets, they have not benefited, and therefore companies selling into that cohort have disproportionately suffered more. As far as a historical context back to 82 on the 1,500, I'd be loath to give you the exact number. I think the key thing here is that the broad average S&P 500 company has not increased, the market has not increased their expectations for what earnings are going to be next year. Yes. And yet, of course, returns, as you said, were very strong, as we could see in that first chart. Well, perhaps we could even dig in a little bit more, thinking about those three distinct cohorts and the drivers behind those. Your observations there, Hugh?
Well, the bottom line is that people were simply prepared to pay more for the near-term earnings per unit of earnings. And what we're showing here, Lance, is the three indexes that we were showing. So the S&P 500, you can see that EPS growth for the overall index, albeit who drove that and how narrow that is a separate thing. But you can see that, the contribution of returns was over 75% is simply the market paying more for the same stream of earnings. For the average stock in the index, actually over 2024, it was all a function of paying more. And indeed, for the equal weighted the 1,500 equal weighted index, where there was a significant decline in terms of that earnings growth, they more than compensated to give you a positive kind of high single digit return by expanding the margin, what they were prepared to pay for those near-term earnings.
Sure. We often get stuck in a point in time around PE levels. Perhaps it's a good time to contrast that with more historical levels. Your observations on sort of where we are today relative to history?
Yeah, exactly. I mean, when else have we seen this in the past? Because, that It's not the only time that we've seen multiple expansion really drive returns. So what you're looking at here is the 2-year change in the PE ratio. So sort of rolling 2-year change from the minimum, okay? And that goes back to really 1950. So you can see that there's been a number of instances where really that 2-year change in PE has been greater than we've seen in 2024, and we've really circled them there. I think there's a couple of things to say, though. It's very natural, obviously, once the market gets comfortable that we're at the bottom of the economic cycle and profit recession, that you're going to expand the multiple, albeit on very depressed earnings. So let's say that a company normally earns $10, they're earning $1, you're comfortable that the $1 is the bottom, you're going to start to pay 20 times that, or 30 times that, or 40 times. So the multiple expands as you would expect. And that's exactly what we saw in the 2 years coming out of the 1991, that terrible recession in the early 90s. So you can see 1993. You can see that that's what happened coming out of the GFC. Of course it did, once we actually hit the bottom and there was a policy response and so on, and people got comfortable that we were through the worst. We saw that in 2002, so that 2000 to really 2002 recession. And we saw it coming out of the COVID recession, out of varying degrees. But that's to be expected. There wasn't a recession in 2024. So the 2 other periods where there hasn't been a recession where we actually saw that were 1999 and in the run-up to Black Monday in 1987. So it is unusual to see a multiple expansion that is not driven by depressed earnings and people getting comfortable that that is the bottom. There's only really 2 times that we've seen a commensurate rise in multiples going back to the 50s that weren't a function of the recession, and the subsequent 2 years you can see from 99 and 1987 weren't particularly productive for owners of risk in equity markets.
Perhaps another way to think about that, that PE sort of across region.
Yeah. So there's a couple of interesting things here. I think it really doesn't matter how you look at valuations, but what we're looking at here, we've been discussing the 1 year forward. We find that, you get into less debate about, is that right or is it appropriate today? You really can't argue that this is the earnings expectations for the next 12 months. I mean, that's only 220 business days. What you're looking at here is, the Nobel Prize winning, Schiller, so cyclically adjusted earnings. And I think the thing to say here is that multiple expansion has left the US market predominantly, and I know we're going to talk about that in a little detail, at nearly 37 times, only been more expensive less than 5% of the time in history. But equally, Japan, relatively expensive on a cyclically adjusted basis. You can see the optimism around corporate change there. And potentially some inflation after years of deflation at 24 times. But really the story is the same, that, emerging markets, Europe, are really very much cheaper than the US market.
Perhaps if we think about profitability.
Yeah, I mean, as you'd expect, listen, at the end of the day, if this really sums up, I think, in some ways what we've been discussing. Yeah. If the market is prepared to pay more for the same unit of earnings, for good and sometimes good reasons, sometimes bad, we haven't touched about why they might have done that. But what you're seeing here is exactly that in a different form, which is just to say, this is the market capitalization of the US equity market as a percentage of the globe, really compared to their profit contribution. And you can see that there's been a widening spread between how much the total S&P of global earnings accounts for, albeit it's been growing in terms of the share, as you can see, compared to the amount that the market is ascribing to in terms of valuation as represented by that equity value in those same securities. So that's a really simple graphic to show that people are paying more for per unit of profit growth, basically, or profit.
So if I think about, and this is perhaps a slightly different question, thinking about everyone who's dialed into the call today, if you're an investor, and I'm also going to put to the side the caveat that we think of the world in a value way. We're a fundamental.
We're going to put that aside.
Correct, but let's put that to the side. You're an investor with a new dollar, ignoring kind of what we've talked about around our style. Should investors continue just to place that dollar? I mean, they've been rewarded. Should that new dollar just continue to, in this example, buy the blue line?
Yeah, so really what you're saying is, do you think that teal line will continue to go ever up? I mean, it can only go to 100, right, by definition. So you're a good way, chunk of the way there. But the bottom line answer is no. I mean, if you go into the next slide, which we put together, let's just contextualize where we've come from. This is last year's total contribution to return in global equities, broken down by region. We've probably wasted some effort putting in France, Denmark, Switzerland, Sweden. We just could have put the US.
Yeah.
That was the return. So your question is partly, hey, does my next dollar also go into the US? Well, the reality is, as you can see on the right, that 74%, $74 per 100 is already in the US. Okay.
Yeah.
So I take it, I know for a fact, just looking at those numbers, that everybody who'd be listening to this call today would have exposure to the US market. So any kind of, we have exposure to the US market, and I'm sure we'll talk about our portfolio. But in aggregate, actually, there's an over-indexation to that US market. And so an incremental dollar, are you suggesting that that is going to go to 80% or 85%? And is that going to purely come from people simply paying more money? Well, that just means that you're going to get subsequently lower returns. If you pay for a 5% yielding bond a certain price or a different price, the return is nailed on. Yeah. In the same way that really an equity is a long stream of cash flows, and the higher price that you pay, all else equal, the lower return you are going to get. So I have a strong conviction that your new dollar should not be looking to be allocating to things that are over-indexed to the US market.
And that's thinking about things in a kind of a regional context. Perhaps something of interest is thinking about it.
I actually really come from, it's really coming from a risk context, because it's been a strong performing market, the US, we know that, particularly from sort of 16 and 17. But why is it that you don't put a new dollar into the US? Aren't they advantaged companies and they're going to do well? And this is an illustration, just a one-day illustration, admittedly. It's just that it's recent, about why you don't do that with your incremental dollar. So what you're looking at here is on the 27th of Jan, so just a couple of weeks ago, the S&P was down over 2%. So you're losing 2% on that day, and yet over 200 of those companies in the S&P went up. So first off, we know that there's $74 per 100 in global equities in the US market. We know of that $40, because of the concentration of the largest 10 stocks, is actually in those largest 10 stocks. So really, this is a cautionary tale about why you need to take that extra dollar and at the very least diversify into something different. Because the outturn, if it was to be like this, is that there was 200 stocks that were up on the day. You did absolutely fine. Albeit if you're in the broad index, or of course if you're in that really concentrated, 40, you lost over 2% of your money. And this was very indicative of what happened in the period of 2001, 2002. Now, in that period, the market was down 38%. There was a lot of companies that were up over that period, a lot in absolute terms. And this is an example that concentration by region, but also within region, leaves you exposed to what's called basis point risk, where a whole cohort of stocks that aren't impacted whatever drives the market down can perform absolutely fine because they're cheap enough and under-owned enough. And so you can profit fine when the indexes in aggregate are performing poorly.
And perhaps a bit of almost a refresher of the value of an active management approach, right? Because what you're really looking at there is the index investors' experience on that day.
That's true. I would just say that with the concentration and, ultimately career risk that a lot of people are running in terms of running asset management, and if you look at the correlation that a lot of performance active managers have, my only correlation to certain indices and,
Sure.
Predominantly the US market, they're in the business of staying in business, right?
Yeah.
It's a big thing to not own large chunks of the US market for many people. I think what you want to be sure of is that if you're giving money to an active manager, is that they are truly active.
And we can actually...
Because otherwise, I think you just take personally, you take a cheaper cost option and just get passive exposure. And then you use active management to give you something genuinely different.
Well, we can come to that actually. We
Okay.
included some thoughts around our portfolio, but actually as a bit of a contrast to the broader market. So Hugh, just thinking about, let's take a step away from looking at the current environment and perhaps focus specifically on the Talaria portfolio. Your observations, both from a risk and return lens, say over the last 12 months, but actually zooming slightly back out and thinking about the last 12 months and 36 months.
Yeah. So you name checked it at the start. Looking at previous tightening cycles and interest rate cycles, as we did in the quarterly at this time of last year, really suggested that the history suggested that it wasn't a high probability that you were going to get a great equity market experience. And of course, we got a second year of 20% returns really driven by the S&P, as we'd shown. So the outturn was high reward, albeit that the probabilities didn't suggest that was likely. So then you're like, okay, great. But really 1 year is not really what drives any long-term kind of investment. Okay, so I think you name checked it at the start that, we're in our 20th year of running just the same one strategy. And what we're trying to do here is, increase certainty, have multiple sources of return, lose less when the market goes down, and participate. So we're trying to really achieve equity-like returns with less risk and give you a much greater certainty of return. And despite what happened last year, or the swings and roundabouts, or the ups and downs, or whatever, and we had a double-digit. We're last 12 months.
Yep.
As of today's double-digit, so it's all fine. The key point, though, is that our rolling 3-year returns is bang on what we've delivered consistently over the last 20. Now, it's probably worthwhile me stepping back and unpacking what you've put up on the screen there, Lance. A number of you will be familiar with this, but let me just talk you through it. This is the entire life cycle returns of the Talaria fund since inception, with each dot representing the per annum rolling 3-year returns since inception. So it took us 3 years to get the first dot. And you can see across the bottom is what you could get if you got a broad market capitalization exposure to global equities. Okay. And what you can see is we've divided that market per annum return on a rolling 3-year basis into regimes. Strong returns, we've called it. You're getting double-digit returns, so that's under the teal to the right there. 0 to 10 or less than 0. And the reality is to December 24, you can see that Talaria has delivered 10.5%, and I know we're going to go through the portfolio.
Yeah.
With far less volatility and getting there from a different way in terms of geography, stocks we own, sources of return, and yet ultimately this is absolutely commensurate or slightly above potentially what we've historically delivered over that 20-year life cycle of managing money in this way. So getting there, as I like to think, via the scenic route rather than on the frantic dash on the freeway. But in the same time frame. Like you got to go the sea route because it took you the same time, where you can drive across the Western Plains on the freeway.
Exactly.
So effectively, listen, there's delivery's been exactly in line with the 20-year history on that rolling 3-year kind of basis.
Fantastic, and obviously the advantage of having a 20-year track record to kind of dot and understand how we behave in different conditions. Just going back to your earlier points around. Obviously, we've got concentration happening on a number of fronts. valuations high. Your thoughts then, looking at the Talaria portfolio, on how we're positioned in light of that?
Yeah, I mean, just to reiterate though, I mean, it's pretty easy to just talk about concentration high. Concentration has never, ever been higher. Okay, ever. By region. And concentration in terms of, top 10 stocks relative kind of position in terms of overall market capitalization, both in the US, but also of global equities, has never been high. So a different way of saying that is that the number of stocks to give you the market outcome has never been lower. It counts only about these stocks, and that's good and bad. So in one sense, within equity markets, people are the least diversified that they've ever been. That's a different way of saying that. And that was that bubble chat. That's why the diversification is something that you should think about, because other things can happen. Yeah, market's down 2.5%, 200 stocks are up out of 500. 40%. Imagine if 40% of the world's stocks went up, but actually the whole index is down in terms of the largest. I mean, that would be a calamity given the level of concentration by sector and by region for a lot of savers. So I think there's actually a pretty serious thing about that concentration rather than it's true, but I feel pretty strongly about it. The first thing to say is on the right-hand side. So it will be strange, as you can see, United States for us is 28% of our total kind of investors' capital. Your capital is in the US equity market. In terms of individual securities, that 74% that we referenced is sort of what the average is. So real difference in terms of some of the other managers that you'd be holding, surely, but that the wider cohort of equity global investors are in. You can see that we're in Europe, UK is about 23%. So, that's sizable. They're all global, there's a whole diversification benefit within there. Switzerland and Japan, two reasonably sizable allocations for us, and Latin America as well. We have 2 positions there. So really a very different geographical mix than where the market capitalization currently is, and indeed where most active managers are. And that's really what the point I was making about, yes, I think there's a case for active management, but there's a lot of active management. You've just got to make sure you are actively being active.
Yes.
So diversification by region, we're going to leave aside the diversification by return type, by our unique implementation process, but diversification as well by sector. I think it's probably worth calling out the IT sector is 1%. That is not for want of trying. Our process, we do it within sector and within region. So we're always looking for opportunities in every sector and every region. We're agnostic in that regard. The issue that we have is the higher quality companies within those, within the IT sector broadly at the moment don't conform to our valuation process. As in, given the range of outcomes that can come, we don't think that you're getting adequately compensated from a valuation perspective. So the things that we have been kind of working on, really they come through and they appear cheap, but they really may not be good value. There's a lot of things there where the near-term cash flows look potentially attractive, but the relative kind of technology risk, the growth rates and so on that they've been able to attain, the loss of market share, maybe the structure of the financing and so on means that there are opportunities that we've passed, and that'll change over time. I mean, in the same way that the portfolio has. So that's one big difference, because obviously we talked about concentration by sector as well as within the US equity market. I call out financials as well, maybe that's 7%. I mean, clearly there's been a strong performance in particularly US banks associated with capital markets, which we haven't really had exposure to. A lot of them have also got large loan books.
Yeah.
From our process, bad loan provisions is about 50 basis points. They're levered 10 to 12 times. Through cycle, that can go to 2.5. Bankruptcies are a 14-year high, and that's announced bankruptcies rather than just things where they're foregoing or foreclosing. Because there's a lot of people not foreclosing because they don't actually want to take possession of the asset. So there's a pretty wide range of outcomes there in terms of the balance sheet. Also, loan growth has been effectively zero. I mean, JP Morgan announced 1% loan growth. So really, given the relative starting valuations, they haven't been attractive from us from our bottom-up perspective. So our financials exposure is really in the insurance space. We have two very high quality global insurers. One is a reinsurer and one's a general insurer. And then pretty diversified healthcare. I think we've talked about that before. I'm sure a number of people on the call we've had discussions with you. And that's been coming down a little bit as several of the stocks we've exited as they've reached our fair value.
Cool. Now we're talking about region and sector, but you did mention earlier, these are ultimately a function or an outcome of all the bottom-up work we do in the portfolio. And whilst there's a lot to kind of take in on the table that I've kind of pulled up, I've often heard you sort of talk about thinking about the portfolio as if it were a holding company and contrasting that to the broader market. Perhaps for everyone on the call, you could sort of step us through that table before us and the things that really stand out to you.
Yeah, great. I do like to look at the overall portfolio as if we owned everything, on behalf of you, the listener, and your clients. It was a single company, and then have a look at the opportunity set, because it's really about, allocation of capital and are our companies high performing, got good reinvestment, structure of the balance sheet, profitable, and what kind of valuation. And it's a good sense check, I find, to bring it all down to not so much the story, but what do I actually own of individual securities. So the couple of things I'd highlight here, what we do is we take the portfolio, so weighted, grossed up as if it was a single security. We index the sales to 100, and we do that for the overall global opportunity set as well, in terms of capitalization weighted. So we use the FTSE Developed World in this example, and then it allows us to look at the comparative. If you owned all of the global equity index, if you owned every global listed equity and you owned the Talaria portfolio, what would that look like? So the first thing I'd refer again, I didn't touch on it, but I did talk about the rising interest rates and rising interest charges for a whole range of companies and a couple of people that have benefited from that. I would highlight, Lance, that there's a really big refinancing wall that's coming in the private sector, starting really from late 25 and into 26. You think COVID, a lot of people there. One of our companies has a loan out to 2028 that they're only paying 25 basis points on. But they'd have to be paying probably about 425 now if they were going to do that. So these are big things, and we're talking about trillions of dollars of listed equities having to refinance as we move through 25, 26. And so the structure of the balance sheet's incredibly important to us generally, but I think cyclically it's important now because of the timing of those refinancings. So you can see that the absolute level of debt to equity is about half of the market. So that's in the middle under the leverage ratio, 66% to 130. The other reason that having a much lower level of debt is important is really around one of your points at the start. Listen, we're making decisions under uncertainty. The future is inherently unknowable. We are subordinated in the capital structure as equity holders. And those companies that carry simply less debt, in the eventuality that things turn out differently, the risk to equity holders is much less. That's a different way of saying leverage works both ways, right? And lower leverage companies over a long period of time ultimately do better. So I think that's a second comfort to me at night when I think about my money in the fund and the company that we own. So that's the first thing. The structure of the balance sheet is robust. I think the second key thing is I would say that, listen, despite the companies we own are really commensurate. We don't own any of some of these fantastic global kind of platform businesses I was talking about, global technology companies. And yet the overall kind of returns in terms of return on equity, and they've got a much more conservatively structured balance sheet, is commensurate with the market. The return on total capital is commensurate with the market. They actually earn more EBIT per dollar of total capital, so they're very capital efficient in that sense relative to the wider opportunity set. So that's a shorthand for saying their business quality and profitability is really high, right? So, and the third key thing, and this is why it's important, is despite being as good a quality as the broad market, we're paying significantly less. Okay, and you can see there's a whole range of kind of metrics there. I think the key thing is on that earnings yield. So that's the dollar of earnings that come back to us and our investors, $8 versus the market of, this $5, $5.20. Despite having a higher payout ratio, so we get a a better yield than the wider market. Because of the cheaper starting valuation, it means they've got a higher retained earnings yield. They're able to reinvest $4.40 versus $3.30 at these double-digit returns. And so that's really the basis of compounding. So cheaper, better capitalized with stronger balance sheets in the eventuality that bad things happen, able to fund their own growth plans as well, not relying on the market. And thirdly, no commensurate drop-off in quality despite being materially cheaper in price. So that's why I really like that, and that is something that I look at regularly.
Fantastic. Hey, just conscious of time, before we get to Q&A, one thing that's worth calling out is we have talked about perhaps investors thinking about ways to diversify. We talked a little bit earlier about other strategies that, for any number of reasons, will behave more closely to an index. If I throw this up, some of the things that stand out to you here in terms of portfolio construction here?
Well, the first thing is, listen, I recognise, we're privately owned. We only do one thing. We're all invested in the fund. All my money's in the fund. I think this is the single best way to run money. I'm also humble enough, Lance, to recognise we're simply a part of people's portfolio.
Sure.
So how we blend, how we add to an overall diversified portfolio for all manner of savers and so on that we work on behalf of is really important. Okay, so I think the first thing I'd say is what you're looking at here, funds 1 through 4, are really, 4 of our largest peers by kind of assets raised, fund flows, where you guys who are listening today and, we meet in terms of our clients have been allocating alongside Talaria. Okay, so they're really the 4 big flows of global equity money in the last 3 years into managed funds. And I think the key thing is, and we hear this back, you hear this back from clients probably more than I do, is that we blend incredibly well. So you look down, our correlation to all of those 4 funds is about 0.33 or less. And once you're under 0.33, it's kind of, I don't want to get into a debate with statisticians. I mean, there's several of them in the team who I can debate later, but that becomes sort of statistically irrelevant. Yeah. Okay, so really good. We do provide something different alongside these other managers who are also doing, by definition, they're doing something different to us. So that's the first thing I take away. The second key thing I take away is that you can see relative to our correlation to the overall index, but also kind of that US cohort of stocks that's really been driving returns, proxied here by the NASDAQ 100, that we simply don't have a correlation. Okay, so that really is a validation point of what I was saying. We portray ourselves as an active manager. Are we an active manager? Yeah, absolutely are, with correlations like that. And yet the rolling 3-year, we got to that 10.5 versus the index doing 12.3, right? That's what I mean about the different driver. I think, so that's the second key thing that I'd point to. And the third key thing is I'd probably leave it to viewers to spend a moment looking at some of the other funds' correlations to some of those things. And that was really my point about paying an active management fee. Are you getting active management outcomes? Is there anything that you would highlight?
No, I think sometimes this, if you were to call out to the viewers, how they might go about doing that, you could obviously run a correlation matrix, but a more rudimentary way may even be just to compare the common holdings across the portfolios. Yeah. We see it all the time. Very familiar names appearing regardless of the strategy, and that's always just that flag around the obvious question of diversification. Now, of course, it plays well in some markets. Sure. It absolutely benefits you directionally one way, but can very quickly decay the robustness of a portfolio from a risk perspective. So that's more the rudimentary way. I would sort of encourage people just to pull up monthlies and compare top holdings. Yeah, makes sense. Now we might cross to Al for some questions on the floor.
Thanks, team. Thank you very much. And we've had some good engagement on the Q&A. So I'll kick off with the first one that came through from Danny Peer. I'm keen to hear Hugh's view on Macquarie's Victor Schvett's recent comments that capital market cycles are dead.
I'm not exactly sure what the capital market cycles are dead. Is that the
Yes.
question?
Yeah, coming from Macquarie's Victor Schvet in some recent comments. Do you have a view on that? You may not, but
No, I think I'd need some context, Al, about, and Danny's very welcome to get in touch directly, obviously, around what he was talking about. I mean, is that, you know, corporates, I mean, we're seeing a shrinking of equity markets in terms of listings globally, okay, over the last 20 years. So equity markets in that sense have become a smaller and smaller relative pool of capital. We're seeing private equity not choosing not to put equity companies onto equity markets, okay, and holding them longer. So in that sense, the amount of transactional IPO capital raising is becoming less. And the third key thing is that, you know, clearly private capital has become a much bigger part of the pie over the last 20 years, if you think of the Apollos and so on. And so founders and people looking for growth capital don't have to come for equity capital. They just come directly to private capital. So I think, yes, that's an undeniable trend that has no sign of changing for now.
Right. And Danny, obviously, if you have any more, want any more detail, we can pick it up after the meeting. This from Tim Farrell. I feel like we've answered this, but just to close it off, if there's anything specific, could you please explain or address the specific numbers for the performance being under expectations over the past 12 months? Income from options, capital movement, etc.
Okay, as in the overall number, yeah. I mean, there's a couple of broad things here. If you're just looking at the sort of 12-month number, it's a function of really what we didn't own. Okay, so you know we talked about that narrowness of leadership, and you know we can certainly send Tim the numbers. IT, you know, if I have a look at even Q4, it was about 320 basis points came from the technology sector, about 140 basis points came from US banks. The rest of it was kind of a wash. So that's kind of really the explanation. The second key thing is that our stocks didn't get more expensive, so they delivered numbers actually above expectations, getting back to the portfolio quality. So that was a second thing. Our portfolio simply got cheaper. And the third key thing is because of this relatively high starting valuation, I think, as everybody knows, the strategy has the opportunity to have up to 20% cash in a truly unencumbered sense. And therefore, the pace of new idea generation, given the fact that we work off a normalized cash return framework, was relatively slower, not relatively faster. So we're up at the higher end of that 20% unencumbered cash compared to other years where we've had opportunities to deploy.
Yeah, great. Thank you. From Doug Perkins, when do you think the market will wake up to the arbitrage that exists by the apparent disappearance of equity risk premium? If the risk-free rate falls, don't we have more to fear from recession and lower corporate earnings?
The risk-free rate falls. Well, that's an interesting question. I mean, as it stands today, about 70% of global market cap is positively correlated with falling yields. So if you look at the last 3-year returns, on days that actually bond yields have risen, equity returns have been negative in aggregate. Okay, so they're positively correlated. Now, I think it depends on when. I think the risk-free rate could as arguably go up, right? Which could be an issue for exactly that correlation of 70%. And that's another thing to consider, which is we've had this tightening cycle, and in basis points terms, it's been one of the biggest that we've seen, obviously, really in a generation. And yet it hasn't got excess capacity out of the system. If you look at unemployment, if you look at kind of utilization rates and so on. And therefore, we're in a situation where we've cut interest rates and you're likely to start to see a re-acceleration in some of the lead indicators, like the Institute of Supply Chain Management survey came out positively this week, which denotes expansion in the manufacturing sector. You're starting to see, obviously, policy impacting immigration in the US in terms of the labour pool. Those two things alone, if you've got, you know, the output gap is very, very narrow, all of that would suggest if we're likely to see a re-acceleration that actually inflation and interest rates will be higher going forward. And therefore, the risk-free rate could well go higher. And that would be tremendously adverse to a whole range of people's kind of portfolios. You know, only probably 6 months ago, you had the market anticipating the FOMC would be cutting interest rates 6 times this year, and that's down to 2 now. So it shows that level of uncertainty out there. So I think the risk-free rate, the other thing that can narrow, and this is a big topic, Doug, which, you know, I'd love to chat to you about, is that if you look at a 30-year basis of China coming into the World Trade Organization, effectively what you had is a lower cost of capital, because effectively they were recycling a lot of their export dollars, you know, that they'd earned back into US treasuries. And so nominal growth was higher, but the interest rate was lower. So the gap is wider. Now, if you're seeing a reversal, and that's really about this re-engineering of global trade, you know, headline tariffs and so on, but also kind of trading blocks and self-sufficiency, then what could well happen is that you start to see that gap between the nominal growth rate and the discount rate starts to narrow. And that's not going to matter any single day, but that would be a tremendous headwind to the price of growth assets all over the world, where we've had a tailwind fairly consistently.
Nice one. Okay, thank you. John Shallett, does Talaria have a view on the Big Seven?
No, not particularly. We tend to spend all our time looking at where we've got capital at risk and potentially new ideas. If they come through the screen, there'll be things that we'll be looking at. But I think you'd be better off kind of referring to those who are experts in those stocks currently, of which there must be hundreds. I mean, Nvidia's got 76 independent people covering it, so there's no, plus all the people who own it. So no, I don't think I've got anything to add there.
Gotcha. Stefan Telder, congrats on the fund performance, true to label, and earns its ongoing role in our portfolios. I wanted to ask for any thoughts on whether any persistent new US tariffs on China are likely to trigger yuan devaluation and sympathy devaluations of major currencies versus the USD, resulting in high USD, Dixie currently at 108, question mark. It's quite a long question. So a high USD is generally inversely correlated with global liquidity by inflating debt servicing and refinancing costs.
Yeah.
Currency volatility tends to reduce liquidity further. US net international investment deficit doubled to 20 trillion over the 5 years to December 23, suggesting foreign investors could readily liquidate US assets to service USD debts. I appreciate yields are much higher than 2022 when the USD last spiked. Is this enough to prevent a repeat? Again, long question. Do you want to take that one offline for Stefan and come back to it, or do?
There's a couple of things I'd say. Firstly, absolutely the liquidity that we've seen over the last 18 months come into the system is reducing, and that's coming from a number of sources. Absolutely, in terms of debt service cost. Because of what happened in the Asia financial crisis, actually they're very well capitalized, right? So where you're seeing people who've got very large US debt liabilities in, but they're local, is places like Eastern Europe. I mean, Ukraine was one of the biggest before the war, but Eastern Europe is actually quite a touch point in terms of that, but that's absolutely true. We've got this refinancing that I was talking about in the corporate sector that sucks a lot of liquidity out. And you've also got kind of the government refinancing where they're going to try to move the duration, where, you know, the previous administration have been using very short duration. So that will suck a lot of liquidity out, one. Two, absolutely volatility of all sorts in all asset classes actually reduces the capital at risk that people who run VAR models and do financing and treasury can run, right? If the range of outcomes is wider, you need to retain more cash, right? Because the range of outcomes by definition is wider. And then the third key thing is there is absolutely no way that in my view, that the Chinese can actually reflate without abandoning the monetary peg. I've said that for some time. I have no view on the timing. It was notable where they changed at the start of this year, just before Chinese New Year in early January, the tenor of their bond buying in China, which suggests very explicitly that they recognize that they can't choose both of the same things. Now, how that plays out into the back of a tariff backdrop, because clearly if China was to devalue 40%, that will be taken as trying to grab global trade share. I mean, whatever the rationale, that makes it a very tricky backdrop for sure. but I think that they have to devalue.
Gotcha. Good one. Thank you. And just very quickly from Richie Parsons, and obviously we can share more, Richie, after this, but can you provide an investment case for Nestle, our investment in Nestle?
In a sort of very
snapshot? Short. Yeah, snapshot, couple of minutes, and we can follow up with Richie for more detail. Yeah,
for sure. I think we've written it up anyway, so we can send something. I mean, at the end of the day, Nestle, and to be fair, HBC, but Nestle specifically, remember our process is really looking at cash returns. And you know, the market normalized cash return would be about 7 to 8. Nestle has had 30 years of 16% broadly cash return in terms of cash invested. Okay, so they are a tremendously profitable company from a cash perspective because of the value of their brands. If you have a look at adjusting for the capital invested versus that cash return, actually the relative market kind of PE, so an economic PE rather than just a kind of return on earnings PE, is actually much lower than a whole range of the other opportunities. That's the first thing. Second key thing is, you know, they've got about a 50 billion stake in L'Oreal that really isn't doing too much. So they've got a whole lot of financing opportunity there. And the third key thing is that they've been able to reinvigorate potentially through an increased AMP in terms of the sales growth. And that's really what it's about in terms of reinvigorating the sales algorithm to then drive effectively these high cash returns. But it's a tremendously profitable company. What's interesting is you look at, and it goes back to this bifurcation, if you have a look at someone like Procter & Gamble, you know, they're trading on, and that was one, funnily enough, in the fund in the low 70s. We tried to get exposure to that. You know, they were sort of not growing. What's the problem? You know, this is now on a 29 times stock, 28 times stock, and they're growing exactly the same in volumes and price that Nestle did last quarter. So, yeah, that would be my thing. The double-digit high cash returns on investment. They need to be able to reinvigorate the kind of several of the brands to be able to drive top-line growth to get that algorithm going again.
Terrific. All right, thank you. Thank you everyone for joining. I think we better wrap it up there. Just to let you know that your CPD accreditation will be sent in the next couple of days. So please check your junk inbox if you don't receive it, or let us know via info@talariacapital.com.au. This session will also be available on demand within the next couple of days. And our monthly report for January will be coming out soon. So a reminder, please sign up to our mailing list if you aren't already on it, and reach out after this session with any questions. Thank you very much for joining us, and we will see you next time.
Yeah, thanks everyone. Yeah, reach out directly if you need.
Thanks, Al.
Cheers.
Bye.